start with a little introduction to XIT CPA. I know a lot of you are current clients, so this is not a mystery who we are. But really, we are a tax and wealth ability firm. I'll give you some little fun facts about us here. But our biggest goal with XIT CPA is that we specialize in helping entrepreneurs achieve financial freedom through strategic tax planning. So there's various ways that we do that. And that's why we hold these monthly webinars, is because we want to make our clients and anybody else who's interested aware of these different strategies and these kind of cutting edge strategies, right? There's some things that come and go as tax years come and go. And so we want to make sure that all of our clients are aware of what their options are and how we can help implement all of those different things. So with all of that being said, Jeremy Lederer is going to tell us a little bit more about what we're talking about for this month's webinar. But as a little introduction to him, fun fact about him, he's a former professional golfer. So that's a cool little tidbit. But now he is the current founder and CEO of XIT CPA. And he is really interested in all of the cutting edge things. Like I've said, we're part of the due diligence project, which many of you may have heard. And that project is a number of companies that come together to make sure that we are understanding the tax code, right? That we're understanding the changes that are happening and the things that are going on so that we can make sure our clients are taking full advantage of the tax code. So with all that being said, I just want to point your direction down to, it's probably at the bottom of your Zoom screen. There's a little Q&A box there. And if you have questions as Jeremy's going throughout his presentation, feel free to submit them there. We'll get to them all at the end of the presentation, but as they come into your mind, feel free to submit them and then we'll be able to talk through them at the end. But with all that, I'll go ahead and turn the time over to Jeremy.
Very good. Thanks, Sophie. Appreciate the introduction. I am happy to be here. I'm happy that you've all made time to join us live or perhaps watch this recording later. We're going to be talking about a new strategy today. We're calling it the AI Pillbox RPM Strategy. And you'll understand more about what that means as we go through the deck here. And this seems like a long agenda, but we're going to work through it in about a half hour, 40 minutes or so. So there'll be plenty of time for questions at the end. These are the titles of each slide. And of course, we want to welcome you in again. This is exciting for me. Like every time I get a new strategy to chew on, it's a good week for Jeremy. So it's one of those weeks. I've been looking at this one for the past 2 weeks actually, and I like it. If you're a existing client, you know what this is about. We are passionate about helping entrepreneurs find legal ways to eliminate their taxes, and this is one of those options for you. If you would like to discuss how this strategy may apply to your unique situation and you're already engaged with us as a tax advisory client, no additional charge, of course. Your service comes with unlimited support from us to understand these strategies and how they might apply to your unique situation. If you're new to us, we want to welcome you in again and offer a opportunity to work with us. Follow up with Sophie after the call, and we'll make sure that we get you routed to the right place. So you're here because you want to eliminate your taxes. You want to do it legally. Even better if you can get a return on investment for that beyond the tax savings. It's rare to find those. I believe this is one of them. So you're in the right place at the right time. These opportunities don't come around often. I believe this is one of them. But as a reminder, my role as your CPA is to look at these strategies from a tax standpoint. That is my area of expertise. There's an investment component to some of these. This is one of those that has that component. And although I may be able to guide you towards the right answer, I'm not an investment advisor. Everyone's risk tolerance is different, which is why this may seem good to some and not for others. But we're glad you're here, and there's no gimmicks here. Everything that we do, or everything that I present to you, is going to be vetted against the tax code, and I can tell you with 100% certainty, if implemented properly, this is a legitimate tax strategy. So this is so the RPM that I mentioned earlier is remote patient monitoring. It's in the Medicare reimbursement space. I don't know how many trillions of dollars that is, or billions or quadrillions, but it's a big category. A lot of businesses are popping up around Medicare reimbursement, and this is a play in that area. It is very similar to the right to use or healthcare software RTU that I presented last year and refreshed last month. It is the same company, actually. It's a new line of software within the same company that did healthcare software RTU last year. This is just a different Medicare reimbursement code. There's hundreds of these different codes that make something reimbursable from Medicare funds, and this is a different category, slightly different category, but same company that offered the RTU last year is offering the RPM this year. As the name implies, it involves a pillbox, essentially measuring the dosage of people that are taking medications. The tax law this year is in flux, to say the least. We got they passed the one big beautiful tax bill recently. It made it through the House. It's likely the Senate will make some changes to it, but I believe that we may have 100% bonus depreciation for 2024, or I'm sorry, 2025 this year, which is good things. All good things for this strategy and ones like it, and we'll explore more about why in a moment. But in a nutshell, 100% bonus depreciation allows for net operating losses to be created, unlike other code sections regarding depreciation, and it has much greater ability to impact W-2 income. So we got remote patient monitoring here. So it's just tracking vital signs, pill usage, mobility, things like that. It's but it's still a software. The actual pillbox would be considered hardware, of course. The company that has developed the software is giving away this pillbox, similar to the way they were giving away the Apple Watch with the kind of the or the RTU offering from last year. So what does it look like? We're buying software again, so that AI-powered remote patient monitoring devices can give the patients the adequate dosage and give their physicians feedback on whether or not the patients are taking their pills. It's the exact same investment metrics or investment offering as the healthcare software RTU from last year. It's a 6-to-1, which means 1 part cash, 6 parts seller finance note. The note is structured the same way with the same company. And then you lease the software back to the operator via a right to use agreement, and they in turn are partnering with private practice physicians to deliver this service to the end user, which is a patient. There is opportunity for a lot of upside on the front end in terms of tax savings via the bonus depreciation. There is an annual income component, and there is also a potential repurchase bonus upon exit. These guys are definitely planning towards an exit. This is very similar to the RTU from last year. And how does it work? Well, that's a great question. There's really a few components to it, but depreciation creates the impact, the biggest impact up front. Even if we're not in 100% bonus depreciation year, Section 179 would apply, which is always 100%. The limitation to 179 is that it's really made for business owners. So if it's not a really high bonus depreciation year, it may be less attractive for high wage earners. But we can run the numbers for you. This works for all different types of entities and individuals, corporations, and whatnot. Again, to reiterate, the 100% bonus depreciation allows for a net operating loss. So even if you don't receive all the tax benefits this year, you don't lose them. They would just carry forward to the next year. So here is a nice detailed slide with some numbers on it. We've got a hypothetical $100,000 cash investment. With the leverage on this, essentially you'd be buying $700,000 of software units. You would buy that through a special purpose LLC. If you don't have one, we can help you find somebody who can set it up, but it would not be you as an individual who would be taking title to these software units. It would be a special purpose LLC, ideally a subsidiary of your holding company. If you don't have those set up, we'd be happy to consult with you on getting that structure in place so that the strategy could be optimized. The real potential investment return here is up to $280,000. The way we calculated that assumes a 40% total tax rate. That's the highest marginal federal tax rate, plus 3% for state. State varies widely. We just use 3%, so we can get to around 40. For those of you that don't know the tax code as well as I do, I'll tell you that the 37% bracket starts at $750,000 approximately for married filing joint, and approximately $625,000 for single filers. We'd want to analyze your unique situation to determine the actual tax savings here, but we're definitely, or this is definitely geared towards people with a lot of a lot of personal income, a lot of potential tax pain. But if this fits your tax bracket, that 40%, you can expect $112,000 in just tax savings in the first year, and that's pretty nice. On top of that, when you're analyzing the potential investment return here, the company you're buying the software from is intent upon paying you $6,000 per year for the right to use the software that you purchased from them. And as a bonus, to align everyone's interests and their intent to exit after a few years, there's going to be a repurchase potential gain of $150,000. So essentially, they're saying that you give them $100,000. They're going, that's going to yield $112,000 in net tax savings. They're going to give you $6,000 a year for the right to use the software, and then $150,000 when they exit the company. And if you add that up, it's going to be $280,000. So on a $100,000 cash investment, the cash on cash return potential here is pretty solid. No one can deny that. A little more math here. Just another way to look at the numbers set there. You remember it's 3 years at $6,000, so got to factor that in. It's important to note that the bonus repurchase is not guaranteed. There's no guarantee on that. That is their intent. A lot of you on this call invested in the first round, the healthcare software RTU phase. And they didn't guarantee it then. They're not guaranteeing it now, but I can tell you from conversations that I've had with them, it's very clear that their intent is to sell the company after a few years, once they're able to achieve a valuation high enough to support that repurchase bonus. Keys to this strategy, or making it work for your situation. For most of you, it's going to be active participation. There may be some of you that already are generating a lot of passive income, but this is a good opportunity to refresh the material participation rules. There are 7 tests defined in the Internal Revenue Code that allow us to classify income as active or passive. The 100-hour rule, if you spend 100 hours in an activity similar to this, or this activity itself, doing those things listed there, whether it's sending emails to clinics, reviewing educational content, or monitoring your own health data, that all counts towards the 100 hours. So would similar things. A lot of people last year were able to make the strategy work for them because they were already doing some sort of health monitoring throughout the year, or they were already doing some sort of tech investing throughout the year that involved due diligence and those sort of things. So what we're looking for is 100 hours in the calendar year 2025 to make this work. So it's already approaching June here. So that makes time of the essence, unless you have a lot of passive income. If you do nothing, if you don't meet the 100-hour rule requirement, what's going to happen is the tax loss created, the paper loss in the first year from depreciation, it'll be considered a passive loss. And you're thinking, well, what's wrong with that? A loss is a loss. Well, no, and yes, but from a tax strategy standpoint, we have to remember always that passive losses can only offset passive income. So unless you have a lot of passive income already, we need to achieve this active participation requirement of 100 hours in the calendar year. And that's one of the things that we do for our clients is provide templates that they could use to track this. What's great about this particular company, they have good technology in place that'll actually track the hours for you that you spend on their site or reviewing their educational content. Like it'll actually create an audit log for us. That makes it a lot easier. So again, there's always risks to this. The tax strategy is pretty solid, assuming proper implementation, which would include the 100 hours, and of course, making the investment in a timely manner. In addition to proving or being able to prove that the debt that you're taking on is at risk. We haven't talked about that component yet, but when we're talking about risk, this is the best time to talk about it. I would suggest to you that if you have nothing at risk, you're not going to get the tax benefits, and it's really not a suggestion. It's a fact. If your downside is limited to only the cash that you put into the deal, so will your potential write-offs. So the way we get this leverage to apply to your income, whether it's passive or active, there needs to be something at risk. So in the closing package, there would be a personal guarantee, and that creates a situation where the seller finance note, there's technically at risk, but I can tell you from having doing the diligence on this as an investor, it seems that they've made it intentionally defective. It's not my place to say whether or not you interpret it that way. I like that there is no third-party bank involved in this one. It's a seller finance software purchase. So a lot of intangible things. I mean, software is pretty intangible. And so is the seller note for that matter. But every one of you is going to look at that package and come to a different conclusion, perhaps. My role again is just to advise on the merits of the tax strategy, which stack up really well against everything else that I've looked at, if you get the implementation right. And just to summarize what that means, it's got to be placed into service this year. That means the transaction has to be closed in 2025. All agreements executed, the cash is transferred. The second component, assuming you don't have a lot of passive income, is you need to get the 100 hours in between the time that you close the deal and the end of the year. So the longer you wait, the tougher that gets. And the third big component from the tax strategy standpoint would be, like we were just talking about, making sure that the debt, there's actually something at risk. So with those three elements in place, the tax strategy doesn't have a whole lot of risks in my expert opinion. The investment risks, not my place to say. Everyone's risk tolerance is different. You need to do your own due diligence. We have a lot of materials on file that we can share with existing clients. If you want to start that process, just let us know. If you're not yet an existing client, we need to get you engaged first before we can share that due diligence package with you. So who this is for? Anybody with a lot of tax pain, really. I mean, you can read that list as well as I can. But if you're looking for personal income of over 200K, I think this would still be a good fit. Like even at 200K, and of course you want to legally reduce your taxes. You believe that you're going to be able to allocate that capital better than the federal government. Let's not turn it into a political conversation here, but like that's why you're here. Like you believe you can allocate your capital better than the government. I've not met one person yet who wanted to pay more taxes than they actually owed, because they knew they could do better with them in their local communities and building their businesses. So yeah, really, that's why we're here. Just a call to action here, the timeliness, and there's some things that are unwritten here that I'll go into. You can read the slide. Um, it's been suggested to me that they're going to start preparing the business for sale. They're going to stop taking new investors, and there's good reason for that. They need to. I mean, I think they've had a couple serious conversations with potential buyers already, and the more investors they bring on, um, the higher sales price is required so that they can fulfill their commitment with the repurchase bonus that I mentioned earlier. That same repurchase bonus was also a part of the healthcare software RTU offering from last year. This is the same company, same ownership, um, same entity, even within that company. So they're going to sell the whole thing together. And the AI Pillbox technology is a different Medicare reimbursement code than the healthcare software RTU from last year, which has synergistic benefits. Together, they are more valuable. So um, they're looking to exit, and they may take investors past June 30th, but I'm not sure about that. They mentioned that date to me and said it would be a good idea if people that were interested at least started the process by then. It's not going to be like last year where this is available all the way into December. I know that's not going to happen. There's other strategies if you want to wait until then, that's fine. But like if you want to get in with these guys as they're planning to exit, really needs to be now. And what the next steps might look like, book a call with me or somebody on my team, depending on how you're currently engaged or whether you're currently engaged. I would send you the due diligence package in advance, and get you connected or reconnected to the founder of the company. But ultimately, what they're looking for is a signed purchase agreement. And once that's completed, once you've funded the deal, we'll start working on the implementation, which would be making sure we've got all those hours documented. I mean, that's what's going to allow this to withstand scrutiny if it came to that. But I will say, like, this is for the next few years likely going to be a period of low enforcement, but that doesn't mean we can cut corners on the implementation. We want everything ticked and tied and documented, just in case. That's what we do. That's what we do here. And of course, then it's up to you to log your hours and monitor your results. They are expecting to do a third quarter. The company will be healthy enough after a year in business to start paying out on these right to use agreements. A lot of you have been asking me when that's going to happen. and what they've told me is Q3. So we'll see. I can't control what they do, but that's what they tell me. Final thoughts here. This isn't a loophole. This is really an example of how the tax code encourages entrepreneurs to use their money. Like we're advancing the healthcare industry with this one. The tax code encourages that and incentivizes that. It's almost like Uncle Sam is your business partner here. Everyone has a choice. It's like, would you rather? Would you rather write $100,000 check to the federal government for your taxes, or $100,000 check to this healthcare software technology company so that they can improve lives? And by the way, you might also get a return on that. So really, we want to help you turn or shift your thinking from the tax code or from taxes. We want to shift your thinking around taxes from them being your biggest expense to your biggest opportunity. And I believe that this is one of those cases. There's the contact email for you. Sophie's got a keen eye on that. We'll make sure it gets routed to the appropriate place. I look forward to hearing from you.